Hello, I'm John A.G., and before we talk about silver, before we talk about supply or deficits or price targets, I want you to confront something uncomfortable. You assume the number on your screen is intelligent. You assume the market knows more than you do. You assume that if something truly dangerous were unfolding, it would already be reflected in price. That assumption is the foundation of modern investing, and most of the time it feels safe. But markets are not omniscient, they are reactive. They are social systems built on confidence, and confidence does not collapse the moment risk appears. It collapses the moment enough people realize the risk was always there. Today, something happened in Mexico that very few financial analysts are discussing in the context that actually matters. A coordinated high-level operation between Mexican and U.S. authorities resulted in the killing of Nemesio Oseguera Cervantes, El Mencho, the leader of the Jalisco New Generation Cartel. This was not a mid-tier commander. This was not a symbolic arrest. This was the removal of the top figure of one of the most powerful criminal organizations in the Western Hemisphere. Within hours, retaliation spread across Jalisco. Roadblocks appeared on major arteries. Armed groups set buses and private vehicles on fire. Thick black smoke rose from commercial districts. Reports emerged of gunfire near airport corridors. Hotels in Puerto Vallarta locked guests inside under de facto shelter-in-place conditions. Flights were canceled. Public transit was suspended. An international tourist destination effectively froze in a matter of hours. Now here's the psychological disorientation. Most investors hear this and categorize it as tragic but local. A security story, a regional issue, something unfortunate that will resolve. They mentally separate it from commodities, from industrial supply chains, from the global financial system. That separation is the false comfort trap, because Mexico is not just another country in the silver market. Mexico produces approximately 190 million ounces of silver per year. That is roughly 24% of global mine supply. Nearly 1 in every 4 ounces of silver pulled from the ground worldwide originates from Mexican soil. Let that sink in. Not 5%, not 10%, a quarter of global production. And the key producing states, Zacatecas, Durango, Chihuahua, Sinaloa, are not abstract geological zones. They are regions where cartel influence has existed for years. With the removal of El Mencho, a power vacuum has opened. And power vacuums in cartel dynamics do not create calm, they create fragmentation. Here is where the market's blind spot begins. When a cartel leader is eliminated, the narrative most people want to believe is that stability improves, that the state strengthens, that violence declines. Sometimes that happens, but often what follows is competition. Lieutenants fight for control, rival organizations test boundaries, territorial agreements dissolve, revenue streams become contested. And what are those revenue streams? Roads, fuel depots, local trucking networks, communities surrounding mining districts, and increasingly, the mines themselves. This is not speculation. In January, employees of Vizsla Silva were abducted near Mazatlan in Sinaloa and later killed. These were mine workers, real people operating within one of the most prolific silver regions on Earth. That event alone shattered the illusion that mining infrastructure is insulated from cartel dynamics. So let's move into the first real mechanism that matters. High-grade silver mines are concentrated sources of recurring wealth. They employ engineers, geologists, heavy equipment operators. They rely on explosives shipments, diesel fuel, water access, and continuous road transport. Every one of those dependencies intersects territory that can be influenced or contested. In a fragmented power structure, targeting shifts from random violence to structured leverage. Kidnapping does not need to be frequent. It only needs to be credible. Extortion does not need to shut down operations. It only needs to extract value. This is the extortion escalation pathway. If silver trades at significantly higher prices, whether $50, $80, $100, or beyond, the economic incentive to control even a portion of a producing district grows. From a purely rational criminal perspective, taxing a silver mine through protection payments or forced contracts can rival traditional illicit revenue streams with arguably less international scrutiny. Now here is the early value reveal that very few are discussing. The global silver market has been in deficit for 3 consecutive years. Demand from industrial applications, particularly solar photovoltaic manufacturing, has expanded materially. Industrial usage is at record levels. Mine supply globally has been essentially flat due to chronic underinvestment in exploration and development. Major silver projects require years, often a decade or more, from discovery to full production. There is no rapid replacement capacity waiting to offset a significant disruption in Mexico. None. If Mexico loses even 10% of its annual output due to sustained instability, that represents roughly 19 million ounces removed from a market already operating in deficit. 15% disruption approaches 28 million ounces. In surplus conditions, that might be absorbed quietly. In deficit conditions, elasticity shrinks. And yet, as of this moment, the futures price does not reflect a structural Mexican supply risk premium. That is where the dislocation exists. Now let's introduce the delayed risk tease. Not all disruption is visible. Mines do not need to shut down permanently for pricing to change. It is enough that uncertainty increases. It is enough that insurance premiums rise, that companies temporarily evacuate non-essential staff, that trucking routes require armed escorts, that quarterly guidance begins including cautious language about regional security conditions. Markets do not react to headlines alone. They react to patterns. If retaliation remains contained and federal forces restore order quickly, the market may continue assuming continuity. But if fragmentation spreads beyond Jalisco into adjacent producing states, the calculation changes. Investors holding exposure to companies with heavy Mexican operations must reassess concentration risk. Let me give you the counterweight because serious analysis demands it. Large producers such as Fresnillo and First Majestic have operated in Mexico for decades. They maintain security protocols. They cultivate community relationships. The Mexican government has significant economic incentive to protect mining infrastructure because it contributes meaningfully to employment, GDP, and foreign exchange earnings. It is entirely plausible that a new equilibrium forms. Violence surges briefly, then stabilizes. Recycling can increase if prices rise. Above-ground inventories in major exchanges provide buffers. The silver market is global, not singularly dependent on one jurisdiction. Those are legitimate arguments, but here's what the comfort narrative ignores. Fragmentation changes incentives. A centralized authority, legal or criminal, imposes rules. Fragmented factions compete through escalation. Escalation creates unpredictability. Unpredictability raises risk premiums. Risk premiums alter capital allocation. And capital allocation shapes future supply. Even if production numbers do not immediately decline, investment decisions may shift. Exploration budgets can be redirected toward jurisdictions perceived as safer. Expansion phases may be delayed pending clarity. Financing costs may rise for smaller operators with concentrated Mexican exposure. The shift does not have to be dramatic to matter. It only needs to be persistent. History offers a pattern, not a prediction. When commodity supply chains break, whether due to geopolitical conflict, export bans, or security crises, pricing adjustments are rarely gradual. Wheat during Eastern European conflict repriced rapidly. Nickel during export policy shocks doubled within months. Freight disruptions altered global cost structures almost overnight. Silver is not immune to these dynamics. It simply has not yet faced a shock of sufficient magnitude in recent years to test them. Right now, the market appears calm. Charts look orderly. Commentary focuses elsewhere. But beneath the surface, a structural variable has changed. The leader of a dominant cartel has been removed. Immediate violent retaliation has occurred. A power vacuum overlaps with key silver-producing regions. A global market already in deficit is exposed to a newly elevated uncertainty. The most dangerous assumption you can make is that because price has not moved dramatically, nothing meaningful has changed. In commodities, stability is not a permanent state. It is a negotiated balance between geology, logistics, politics, and security. When one pillar weakens, the others compensate, until they cannot. And the question now is not whether Mexico will produce silver tomorrow. It almost certainly will. The question is whether confidence in uninterrupted, frictionless production has quietly begun to erode. Because once confidence shifts, price eventually follows. If you think about how markets usually respond to danger, they do not respond at the first sign of smoke. They respond when the smoke begins to interfere with breathing. And right now, most silver investors are still breathing comfortably. They see futures trading in familiar ranges. They see no emergency bulletins from major producers. They see no official declaration of force majeure. And so they assume the system is intact. But markets are not destabilized by headlines. They are destabilized by friction. Let's talk about friction. A silver mine is not just a hole in the ground. It is a chain of dependencies. Ore must be extracted, crushed, transported, refined, and shipped. Workers must commute safely. Diesel must arrive on schedule. Explosives must be delivered and stored securely. Water access must remain uninterrupted. Equipment must move across highways and through checkpoints. Every link in that chain touches territory. And territory in Mexico is not just geography, it is influence. When a dominant cartel structure fragments, influence becomes fluid. Fluid influence creates negotiation. Negotiation under uncertainty creates cost. This is where the second-order effects begin to accumulate. Imagine a mining company operating in Zacatecas. Officially, production continues. Trucks are still moving. The quarterly report still shows output. But internally, the company has hired additional private security. It has adjusted transportation schedules. It has increased insurance coverage. It has diverted capital from exploration to operational protection. None of this appears dramatic on a price chart. Yet each adjustment tightens margins. Now extend that across multiple companies. Junior miners, in particular, operate with limited capital buffers. They rely on stable projections to raise equity or service debt. If lenders perceive increased jurisdictional risk, financing terms tighten. Equity investors demand a discount. Cost of capital rises. Projects that were viable at a certain silver price no longer meet required returns. Once risk premiums expand. The ore is still underground, but the incentive to extract it weakens. That is how supply curves shift without dramatic shutdowns. And here is the deeper layer that many are missing. Mexico's mining sector has operated for years within a delicate equilibrium. Cartels, local communities, federal authorities, and corporations all understood the informal boundaries. When a leader like El Mencho is removed, that equilibrium resets. Competing factions test leverage points. They probe where revenue can be extracted. Mining districts represent concentrated, visible value. It does not require open warfare to disrupt production. It requires unpredictability. If one faction controls a corridor this month and another the next, continuity becomes fragile. If community leaders are pressured by rival interests, local consent becomes conditional. If contractors fear association with unstable zones, logistics slow. This is the escalation pathway that does not show up in headlines. Now let's examine the global backdrop more carefully. Silver has been in structural deficit for 3 consecutive years. Industrial demand, particularly from photovoltaic manufacturing, has expanded significantly. Electrification trends, electronics, medical applications, all of them consume silver. Mine supply has not meaningfully expanded in response because exploration budgets were suppressed for over a decade during lower price environments. Major new mines require years to develop. Even if capital were deployed aggressively today, incremental production would not arrive quickly. That means the global system depends on existing producers maintaining continuity. Remove or impair even a fraction of Mexico's 190 million ounces annually, and the margin between supply and demand tightens further. In surplus markets, disruptions can be absorbed quietly. In deficit markets, elasticity is thin. This is where psychology becomes critical. Industrial buyers do not wait for confirmed shortages. They hedge anticipated risk. If procurement teams begin to question reliability, they extend contracts, secure inventory, or increase futures exposure. That incremental hedging demand pushes against limited supply. It does not take panic, it takes precaution. And precaution can move markets. At the same time, we must acknowledge resilience. Mexico has endured cycles of violence before. Mining has continued through difficult periods. The federal government has strong economic incentive to protect high-value sectors. Security forces may rapidly stabilize critical corridors. Fragmentation could, paradoxically, weaken centralized cartel influence and reduce coordinated interference. That is the optimistic scenario, but optimism does not erase concentration risk. Nearly a quarter of global mine supply originates from one jurisdiction. That level of concentration creates systemic exposure. Investors often speak about diversification in portfolios, yet the silver market itself is structurally concentrated. Now let's introduce a more subtle risk: policy response. Governments under pressure sometimes respond with visible regulatory adjustments, increased oversight, higher royalties, stricter permitting standards, enhanced environmental compliance. These measures can be framed as strengthening governance, but even well-intentioned policy shifts introduce cost and delay. For smaller operators, delays can be fatal. Capital markets are unforgiving when timelines extend unpredictably. For larger firms, compliance costs accumulate. Over time, fewer players control more output. Concentration intensifies. In a tight market, concentration amplifies price sensitivity. There is also the currency channel. If instability pressures the Mexican peso, miners may initially benefit from lower local cost bases in dollar terms. But sustained currency weakness can signal capital flight and macroeconomic stress. That stress can trigger fiscal responses, which feed back into corporate profitability. You begin to see how layered this becomes. Security risk feeds financing risk. Financing risk feeds investment decisions. Investment decisions shape long-term supply. Policy risk feeds cost structures. Cost structures feed pricing. All of this unfolds gradually until a tipping point is reached. The tipping point rarely announces itself. We are currently in the phase where price has not materially adjusted. That does not mean risk is absent. It means the probability weighting assigned by market participants remains skewed towards stability. But probability weightings can change quickly if evidence accumulates. Watch for subtle signals. Language in earnings calls referencing heightened regional volatility, adjustments in capital expenditure guidance, temporary evacuation of non-essential staff, insurance disclosures, delays in exploration drilling. These are early indicators of friction, and friction compounds. If multiple companies independently report minor disruptions, the narrative shifts from isolated event to pattern. Once a pattern is perceived, hedging behavior increases. Futures markets respond. Spot markets follow. The midpoint realization is this: silver does not need a dramatic shutdown to reprice. It needs enough participants to question the assumption of seamless Mexican output. Confidence is not binary. It erodes incrementally. And here is the most important element: time. If violence remains contained and new leadership structures consolidate quickly, the system may restabilize. Risk premiums may fade. Investors who anticipated disruption may find themselves early or incorrect. But if fragmentation persists for months rather than weeks, if minor incidents accumulate, if uncertainty becomes the baseline rather than the exception, the repricing mechanism becomes far more likely. Markets ignore risk until they cannot. Right now, the silver market appears to be in the ignoring phase. That may prove rational. It may prove complacent. The difference between those two outcomes will not be determined by headlines alone. It will be determined by whether the structural incentives created by this power vacuum translate into sustained friction across mining corridors. Because once friction becomes systemic rather than episodic, the calm on your screen will not last. And when calm disappears in a deficit-driven commodity market, the move is rarely gentle. What makes this moment different is not the violence itself. Mexico has experienced violence before, mining has continued through instability before. What makes this moment different is the structure of the global silver market sitting beneath it. We are not in a period of oversupply. We are not in a cycle where inventories are building and demand is weak. We are in a tightening environment where industrial demand has expanded materially, investment interest remains present, and new large-scale supply projects are limited. That context changes how risk must be evaluated. Let's shift from headlines to structure. Silver is both a monetary metal and an industrial input. It flows into solar panels, electronics, medical devices, electric vehicles, and infrastructure. Industrial users do not treat silver as speculative. They treat it as essential. If supply reliability is questioned, procurement behavior changes immediately. Contracts are extended, stockpiles are increased, futures exposure is expanded. That shift does not require confirmed shortages. It requires uncertainty. And uncertainty is exactly what a power vacuum produces. If fragmentation within cartel structures leads to unpredictable territorial control, mining corridors become variable rather than fixed. Even if mines remain operational, logistics can slow. Even if logistics function, insurance costs can rise. Even if insurance absorbs risk, financing terms can tighten. Each of these adjustments slightly increases the effective cost of supply. Markets can ignore rising risk until cost structures begin to reflect it. Now think about concentration again, roughly 190 million ounces per year from Mexico, approximately 24% of global mine output. Remove 10% of that due to sustained disruption, and you are looking at roughly 19 million ounces missing from annual flow. Remove 15%, and you approach 28 million ounces. In a balanced market, that might be manageable. In a deficit market, it becomes meaningful. And here is the asymmetry. If stability returns quickly and production remains uninterrupted, the silver price may drift according to macro forces: interest rates, currency strength, risk appetite. The upside tied specifically to Mexican supply risk may never materialize. But if disruption deepens even modestly, the repricing could be nonlinear. Commodity markets often move slowly, then suddenly. We have seen this pattern in other resources. Export bans in mineral-rich countries triggered sharp revaluations. Geopolitical conflicts affecting agricultural exports caused rapid price spikes. Maritime disruptions reshaped freight costs in weeks. In each case, markets initially treated the risk as temporary noise. Only when participants collectively reassessed durability did prices adjust decisively. Silver has not yet undergone that reassessment tied to Mexico. That does not guarantee it will. It simply means the structural variable has changed before price has. Let's introduce another dimension: capital allocation. Mining is capital intensive. Investors deploy billions based on assumptions of jurisdictional stability over multi-decade horizons. If Mexico's perceived risk profile shifts even slightly, global capital may gradually reallocate toward jurisdictions deemed safer. Exploration budgets could pivot toward Canada, Australia, or parts of South America with lower perceived volatility. This would not show up immediately in production statistics. It would show up years later as project pipelines diverge. And here is the uncomfortable question. If nearly a quarter of global silver supply rests in a region now entering an uncertain power transition, how much disruption is required before global participants reprice risk? 5%? 10%? Or simply the credible possibility of those numbers? Because markets do not require certainty, they require probability. At the moment, the probability weighting assigned by futures markets appears low. There is no dramatic premium embedded in price. The calm suggests confidence that stability will prevail. That confidence may be justified. The Mexican state has incentive to defend mining infrastructure. Large producers possess security resources and deep local networks. Fragmentation within cartel structures could weaken centralized power, and ultimately reduce interference with economic sectors. Above-ground inventories and recycling provide temporary buffers. These are real counter-arguments. But confidence is a fragile currency. If incidents accumulate, temporary evacuations, delayed shipments, subtle language shifts in corporate disclosures, confidence can erode gradually. And once eroded, rebuilding it requires sustained evidence of stability. The practical reframe is not to panic. It is to reassess assumptions. If you hold exposure to silver miners heavily concentrated in Mexico, understand how jurisdictional risk factors into valuation. If you hold physical silver, understand how supply concentration shapes long-term dynamics. If you trade futures, recognize that geopolitical supply risk behaves differently than macroeconomic volatility. This is not about predicting collapse, it is about recognizing asymmetry. Downside for silver tied to Mexican stability returning is incremental. Upside tied to sustained disruption in a deficit environment could be significant, and that is where the psychological tension sits. We began with the assumption that markets are intelligent and all-knowing, but markets are composed of individuals reacting to information at different speeds. When information shifts from anecdotal to structural, reaction speed matters. Right now, the removal of a dominant cartel leader and the immediate violent retaliation are facts. The overlap between that power vacuum and key silver-producing states is a fact. The global silver deficit is a fact. What is not yet determined is whether those facts converge into sustained disruption. The most unsettling part of this situation is that you will not receive a clear announcement if convergence begins. There will be no single bell ringing. Instead, there will be incremental signs, slightly higher risk premiums, subtle language in earnings reports, gradual hedging by industrial buyers, a futures curve that begins to shift, and then, at some point, the calm you see today will look like a moment of complacency in retrospect. Or it will look like a moment when the system proved more resilient than critics expected. That is the uncertainty you are sitting with. So here is the final question to carry with you. If confidence in uninterrupted Mexican silver supply has been an invisible pillar supporting the global market for years, and that pillar is now under structural stress, how much evidence will you require before you accept that the foundation may be shifting? Because by the time the market answers that question decisively, the price will no longer be asking it.